As far as a successful audit, what would you say constitutes a successful audit? Take us through what constitutes a successful audit. Some secrets there.
Okay, the secrets of success are to get the power of attorney right away and to utilize someone who is experienced in it if you're not. And another thing to remember, based on the advice of the accountants that we've talked to, is the longer the audit lasts, the better.
Why is that?
Well, for some reason, you imagine your client, of course, may be losing sleep or maybe having heartburn over this, but while it's going on, they're not actually thinking about your case necessarily. They've got a lot of cases going on, and the longer it goes on, usually in their experience, the more likely that you're going to prevail with, as a successful audit, it's called a no-change audit. Even though in some cases where the IRS will find out that you possibly have a refund coming, maybe you understated your deductions on meals, and really they were business travel entertainment. In one example comes to mind, the IRS will not normally, in the experience of the folks we've talked to, grant you that at that point, unless you're going to do trade-off at the end when you're mediating, when you're getting into a manager's conference or an appeal situation where you're sort of trading. Well, we have these that we didn't deduct, and you have these that you say that were not deductible. And so you actually do a little bartering and trade those. But in the cases where you may have deductions and they haven't found any unreported income, which is one of the major things they're seeking, when they're done, they'll issue a no-change report. And if you say that to anyone, I've talked to folks before, and they say, we got a no-change letter. Well, so what? But no change is very
good news.
It's excellent news. And you're not done yet, actually. When they leave and they submit a no change, they were actually reviewed a few years ago by Booz Allen Hamilton, the consulting firm, and they streamlined the way that they do audits. So now they're coming out generally not doing fishing expeditions, but they're looking for certain things. And at that point, if they haven't determined that, whether it's a basis consideration or always looking for unreported income, then when they're done, they say it's a no change, or they may say it during the audit. So it's important for the accountant then to ask them, you said it was going to be a no change if this didn't happen, so we'd like to get the no change letter. Then it's still subject to the review of their manager, and then after you get that letter from the manager, the audit's over.
Then you're good to go. So what do you look at for next year? So you've been through this somewhat agonizing procedure, I guess, for a lot of people. What do you look at for next year? Do you take special care to be sure that you don't ring those same bells that you rung the year before, or what do you do to be sure that this doesn't happen again?
Right. Yeah, that's a good question. Most people don't want it to happen again. Actually, they have their own guidelines which say that they will not come back and look for the same thing. However, if you're being audited and they do find things that are not right, that you do have unreported income, or that you were aggressive on your deductions, well, then they'll normally go back to the prior year and possibly audit the open year. There's 3 years that are open, the one they've chosen and the one prior and the one that's coming up, because usually they're auditing a year in arrears. So they can look at all of those. And then some small business people have several different entities, a couple of different subchapter S or LLC, or a Schedule C for that matter.
Sure.
They could go on to other entities. But the practitioner in managing the whole situation is better to ask them, let's finish this entity, and then if you want to open another entity, we'll open it up. Now, if it's going to be a no change in all likelihood, there's not really any reason for them to go on to the other entities or to prior years. And in our experience, talking to CPAs and EAs and people that do this, they don't.
So again, the no change is what you're really looking for.
Yeah, you're seeking the no change. But in the subsequent year, your question, Ben, usually people will keep better track of all of their credit cards. They'll then know that the audit's going to take place based on the tax, not just the tax return, but the bank statements. And so anything that goes into the account And sometimes people are moving money in and out of entities from their own personal account. Small businesses, sometimes they often have to make payroll. So if they're short on money, they'll infuse money into it. Well, the IRS is looking for all that to be reconciled as if it were revenue from sales. So they'll be more careful to make sure that anything that goes through the bank statement is well documented.
Let's talk just a minute about triggers. What triggers an audit? What are things that the common businessman and tax preparer would need to be aware of? Maybe as they're preparing that tax return, they can say to their client, hey, that's a problem. This is going to cause you an issue. This could get you audited. What are some of the common triggers that are out there today that they're looking at?
Well, it's a couple of things that you want to stay away from in due course that we've learned by talking to other accountants and some of our own experience, which is you don't check the final return box on a return unless you've completely wound down that particular entity, LLC or sub S, and you're about to file zeros. Otherwise, that's the final return, so logically they would want to come out and do what they call a basis calculation. A basis calculation is if you reported losses, where was the money in the business to lose? So the small business person would have loaned the company money or made a capital infusion or moved money from another entity to establish basis for those losses. And that's a common interest from the IRS, and it's triggered by checking a final return when there's still financial activity in that particular entity. Some of the things that people imagined were audit triggers are not the triggers they once were, and the home office deduction was sort of the one. Well, if you're going to deduct home office, you're automatically going to get audited. That's changed because so many people do operate out of their homes, and there are good reasons why you would operate out of your home. And if you're doing actual work there and you have a separate facility and you see clients there, you have employees come there, that's a defensible deduction.